Good morning. We are Team N. My name is Alex.
I'm Johanna.
I'm Connor.
I'm Zach.
I'm Garrett.
And today we're initiating coverage on Pulte Group with a hold recommendation. Starting off with a little bit of background about the company, Pulte Group is a true American success story. Back in 1950, William Pulte grabbed a few of his close high school friends, and together they built a 5-bedroom bungalow on the outskirts of Detroit, Michigan. Using a floor plan out of the local newspaper, they successfully completed this first build and sold the home for $10,000. This is the first of many homes that Pulte would build, and now they are the third largest home builder in the nation. Starting off, we have a target price of $59.97 and a hold recommendation based on the following merits and concerns. We do recognize that our target price is above the last closing price, but we have a few different scenarios that have led us to this conclusion that we'll discuss throughout this presentation. Looking at business description, Pulte Group has three main business divisions. Single-family home building is the core of Pulte's operation, and it accounts for 96% of revenue generation as of 2021. The remaining 4% comes from land sales at 1% of revenue generation in 2021, and then financial services at 3% of revenue generation in 2021. Pulte Group is also geographically divided into 6 different segments across the U.S., with the West Division and the Florida Division accounting for almost half of the total 2021 sales by region.
So now to just look at the home building industry as a whole. So based off of our Porter's 5 Forces analysis, you can see that this is a highly competitive industry, as most aspects are from medium to high. But a few things that we did want to kind of call out, as they'll play a role into our valuation and our models later, was that this industry is very driven by unit economics, and so that'll play a part into our model later. And as it is a home building industry, U.S. housing demand is going to play a large part, which is impacted by interest rate hikes as well as unemployment, because that will impact consumers' price points for houses as well as their demand. And then another thing that we want to touch on is just the pandemic-related supply chain issues, as the raw materials needed for home building operations were halted for a little bit, which kind of impacted the costs that would be associated with building homes. And now to just look at how Pulte positions itself within this industry. So it is a single-family home building industry. That is their target, and they target the middle-class families mostly. And as I said, this is highly competitive, but Pulte has a really strong hold within this industry, as they have been established. And you can see by the industry revenue breakout that they make up 14% of the industry revenue. So their brand recognition and reputation does give them a competitive edge above the local home builders that you might see, and even the national home builders competitors that they compete against.
So looking at Pulte Group in terms of financial analysis, starting with debt to equity ratio, since 2017, you can see Pulte Group has been continually paying down debt, and this has resulted in an improvement to their debt to equity ratio. And this is really important because as we head into more uncertain times in terms of cash flows and whatnot, this will give them more room to absorb any sort of financial losses or shocks to the housing market. Additionally, looking at DuPont analysis, you can see that the return on equity for Pulte Group has been steadily growing. This is in large part due to the net profit margin improvement that we've seen. Now, that trend has helped all of the peers of Pulte Group as well. However, if you look at that right-hand side chart, you can see that they're second only to D.R. Horton in terms of their profit margin. So they still stand above. And breaking down the operations of Pulte Group a little bit here, starting on the left-hand side, you can see what orders and closings looked like during a pre-COVID interest rate environment. As we headed into a period of easing monetary policy where costs of borrowing were very low, you can see the number of people taking out mortgages rapidly increased and the trend decoupled. However, as rates went back up, you could see that demand for new orders dropped off, but the key thing to note here is that the number of closings continued to move upwards because homes that have already been ordered still need to be closed on, so that trend lags behind. And then in terms of where we're heading, Pulte Group from Q1 of 2021 to Q4 of 2022 experienced a decrease of over 7,000 homes to their backlog. And now Zach will talk about their valuation.
So using a discounted cash flow model, dividend discount model, and relative valuation model, we calculated an overall target price of $59.97. This is a almost 13% premium compared to the current stock price, but we ran two other scenarios through our model as well. One where the yield curve shifted upward compared to where it is right now, and one where at the peak the yield curve flattened, and those came out with share prices a little bit below our base case DCF, so we didn't feel comfortable initiating a buy recommendation where we saw two scenarios where there might be a sell-off of the stock depending on what the Fed does in the next year. So with our weighted average cost of capital, we used the 10-year Treasury risk-free rate for our risk-free, and then used regression against the S&P 500 for our beta, and then the matter and equity risk premium. Some of the assumptions that went into our model, it's really driven based on, everything else is based on revenue, but revenue is driven based on homes sold and prices of homes. So we used US housing demand and historical relationship between orders and closings, along with the interest rates environments that we were in previously to feed through our model. Cost per home was based on the producer price index, and then something to note, our average selling price of homes we expect to fall through 26. And then our terminal growth rate, we used 2.5% since PulteGroup is a mature business and a mature industry. Our dividend discount model resulted in a price of $53.77. We used the assumption that despite previous years of strong dividend growth rates, the reduction down to 7% in 2022 would continue in the next couple of years with the current uncertainty, and then a terminal growth rate of 9% more in trend with historical growth rates. And then for a relative multiples method, we used 5 ratios compared to their peer group of 15 peers taken from CompuStat. They're all single-family home builders.
All right, on to ESG, starting with environment. PulteGroup strictly complies with all of the required regulations and requires their suppliers to do the same thing, which greatly reduces legal risk for investors. Additionally, they're aiming to build a net zero or zero net energy houses. And the social, they have a diverse leadership composition. 25% of their executives are diverse and 40% of the board of directors are. And they established their diversity and inclusion board in 2020, and they give the charity Built to Honors for veterans, providing work with free housing. And their charitable foundation aims at giving back to their communities and providing education for future home builders. For governance, they have strong alignment with leadership and shareholders. To start with their compensation, 87% of the executive compensation is tied to financial or operational benchmarks. And they have a clawback policy, which requires their executives to reimburse PulteGroup for any detrimental conduct they engage in. The board is 90% independent. They have institutional holdings of 93.93%, and they conduct unannounced audits to ensure compliance.
To recap, we're issuing a hold recommendation on Pulte based on the following merits of consistent dividends, strong margins, and an established market presence, coupled with the concerns of reduced housing demand as well as interest rate uncertainty. Thank you, and we'd be happy to answer any questions.
How is the company planning to manage the declining, I think you said decline in selling prices versus the cost of goods are either increasing or remaining the same? How are they managing that?
We're expecting that while there's still some sticky inflation that's going to stick to some of the inputs for their costs, we're still expecting costs to come down. So I think through 2025, we're going to see gross margins decrease to around the mid 20% rather than the high 20% and up until 30.
Can you talk to me about how they allocate capital in terms of making decisions about dividend? And should we even use a discount dividend model if the dividend is only 1%? Does it really represent much of the company's overall expenditures?
Yes.
Yes.
Does anyone take it?
I would say, so to kind of take the first part of, Pulte really does value their dividends. They've been giving dividends out annually, regularly, so that's of just company-wide, that's kind of policy they have even throughout the pandemic when they did kind of lose cash flows to an extent, they were still prioritizing the dividends. To the point of it does make up a small percentage of the company as a whole. I would say that's why we weighted it lower. We do recognize that it doesn't, that's not the highest weighted valuation method, and so that's why we didn't weigh it as heavily. And then we also considered the DCF various scenarios that we had within the chart that weren't built into the model, but was a part that played into our hold recommendation as opposed to initiating a buy.
Everything recently from the company has had a huge emphasis on returning some of that capital to shareholders. So in the form of share repurchases and dividends, they've done really well at expressing that. So like Joe said, we decreased the weight of that in our valuation, but we didn't want to ignore it.
Isn't it more efficient to buy back the shares from a tax perspective for the end client?
Yes, they do much more of share repurchases than, as you can see, with dividends, but we still wanted to model out the dividends with the upcoming cycles.
Thanks.
Can you give me a little more flavor of the ESG here? Is this company, in your opinion, above average or below average? What
Yeah,
would you-
we have a chart for that.
Can we get
All right, so here we go. So this is the ESG scores scored by Bloomberg for Pulte Group and their competitors.
So you use peer group, not just the overall companies in the U.S.
Yes.
Okay.
We compared their peers with 10 being the lowest risk and the lower the number being greater risk. Something to note is you'll see a bunch of zeros. This doesn't necessarily indicate the highest risk. It just means that Bloomberg doesn't have the sufficient information to make a conclusion on that score for that particular group.
And your opinion is above average or below?
Right about at average. They have strong governance and they're social. Their environment could be better, but it's about at average. And yeah, it's strong governance really.
Thanks.
Going back to the margins, I was wondering, from your perspective, is there an underlying business strategy between Pulte and Spears that's causing them to have industry margins, or is it just more pricing power or some other factor?
from the research that we did, it's more of a pricing power thing, and then additionally the market that they're in, so the price point that they're selling to, the upper middle class-ish range experience the best margins.
And they have been increasing the selling prices of their homes. So
Can you talk a bit about the mix of land options versus land ownership that Pulte is using and how you see that maybe evolving in the near future?
I would say they definitely do utilize land options, which plays into kind of a competitive advantage. I would say going into the future, I would say that they would even utilize it more so, especially given the fact of the uncertainty with the market and with the inventory and orders kind of hitting that low that we saw in that one graph, just having flexibility in whether, interest rates go up, interest rates flatten, just having that flexibility to adjust as needed depending on what the market and consumer demand changes.
With the cancellation rate in the backlog going above 30% in 2022, we're expecting them to not use a lot of those land options that they already have.
Any thoughts on a particular price point that's more attractive? Whether it's move up, entry level, active adult, and they're just wondering from a, I guess, growth perspective, if does Pulte have any levers to potentially help stimulate demand for those particular price points?
Could you repeat the question? Sorry.
Yeah.
I guess just wondering, is there a price point from your perspective that's more attractive compared to the other vendors?
With the margins that we saw, and then the margin growth that we saw with their peers at the price point that Pulte's at right now, we concluded that Pulte should stay where they are with their price point.
I think what he might have been trying to ask is there a margin difference between the move up, first time, and adult? And is one better than the others, or are they all the same?
We did not do an analysis on that, breaking it down.
Can you remind us how you approach the terminal value for your GCF and why you chose a particular approach?
The growth rate?
Yeah, the terminal value, which
2.5%.
yeah,
The terminal growth rate of 2.5.
you use it at growth rate
Yes.
rather than an EBITDA multiple.
Yeah, so our thinking was because it's such a mature industry and Pulte having such a stronghold in the market and being so established, we just went with the expected standard terminal growth rate.
And what was the growth rate was based on what?
Throughout the
An expected GDP growth of 3% and inflation of 2%.
Does their presence in the southeast tell you that they should use a higher growth rate because the housing and population growth in those areas of the country is greater than the average?
A higher growth rate for terminal?
Yeah.
Theoretically, yes, but we didn't feel comfortable upping that growth rate compared to what we felt was standard at 2.5%, just because that has such an effect on that target price.
Yeah, but isn't that why Pulte is successful? Isn't that why the margin is higher, because they have a higher growth area of the country and the costs are less in the southeast?
Yes, but terminally, those areas, the growth in that area is expected to slow down at some point.
And to add to what Zach is saying, trends don't last forever, right? And terminal growth rate, that's extending out. So, today that might be the case, but tomorrow might be different. So we just went with the standard.
What would you have to do to get this to be a buy?
For us, we just need more information, which is going to take a year to get. We feel that if interest rates do shift upward, or if the curve flattens, that people who held could potentially be hurt a bit, that there will be a bit of a sell-off, but if the yield curve stays where it is, we're expecting the share price to rise to around $60. So if we see good news that interest rates should start to come down and towards the back end of 2023 or beginning of 2024, then we'd quickly initiate a buy.
Last question for the judges. Can you tell me a little bit about their financing, how they provide financing to their clients, and how that works, where they source those funds? Are they using third parties to provide that capital?
Yeah, so they don't go super in-depth on how they source the capital within their financial statements, and it does make up such a small portion of their revenue that we didn't go in detail, and the details that we could find weren't easily accessible. But I do believe that they source it themselves as opposed to third party. But again, they don't go super in-depth within their financial statements, so I can't say for certain their process.
And I'll add to that by saying that, Garrett talked about those different foundations they have and that sort of thing. And a lot of the financing they provide is like either for their own employees or people like in those programs and that sort of thing. So,
Thank you very much.
thank you.